Good afternoon to everyone. Can you all hear me? If you can, please send a message saying yes.
Yes, sir.
Thank you so much. Uh, this is the first um, discussion for this subject. You all can see my slides as well. Now, the course is Postgraduate Executive Diploma in Banking Management. The subject is a financial system. Is it clear? Everybody is on the board? I hope so. Okay, under this subject, first of all, just want to show you all the areas what we are going to discuss actually. So the first one, the analysis of interest rates, and second, the analysis of exchange rates, then monetary policy, thereafter financial intermediation, the regulations of the financial institutions and financial management or markets, derivative instruments, financial markets, then portfolio theory and pricing risk, and then corporate and personal sector financing, and finally, the properties and pricing of financial assets. So this will be our core area under this subject, financial system. The first five chapters I'll be discussing with you all, then other five will be discussed with another lecturer. So first five we'll be discussing for next 5 weeks. So one more announcement as well. So next week we won't be having this online class, and thereafter will be as usual. You all can ask any questions, better sending messages, or if you want, you can mic on and ask questions. So I encourage you all to send questions through messages so I can read and reply to you. That may be easy. Otherwise, maybe there may be interruptions that others cannot understand. Then now key areas under this financial system, right? That's a chapter. Those are the chapters coming under this subject, right? Okay. So how we are going to assess? There will be end of this session series. So there will be an exam. In that exam, the paper consists of 6 questions, and the first is mandatory, and the 40 marks will be given to that first questions. And then out of other 5 questions, you have to answer 3 questions. So then you'll be getting 20 marks each for those 3 questions. So altogether 100 marks. And also, I just would like to say the reference as well. The better reference is the Economics of Money, Banking and Financial Markets. That's a 10th edition. Why I mentioned the 10th edition. So it's quite availability is high. So you can get that book anywhere in the library and you can read that. So it's very important to read those reference books, and similar books also you can use as reference. Okay, this is the overview of this subject. So then I just jump into the series, lecture series. The first, today we are going to discuss about a broad introduction about financial system. So then we can go in detail each and every area and we can discuss. So you should remember most of the questions, all the questions will be coming from the area we'll be discussing. So no need to worry. right? Only thing is you should have better understanding of all these aspects. So today, as I said, like we are going to discuss points that gives a overall perception of what is financial system, what are the components in that financial system, or what are the benefits of having a very good financial efficient finance system. So it's overall you should be able to understand what is financial system, right? Is that clear? Yes. So then I'll be moving into our agenda. The first will be introduction to financial system, then functions of the financial system, then financial markets, financial instruments, regulations, and impact of globalization. So here, like, yeah, yeah, that will be the order. Yes. So I'll be moving into the overall aspect before starting about this financial system. So this is very important to have a mind mapping so you can relate anything, you can relate anything to this financial system aspect into economic system, so you can easily remember the basics of this financial system. So before starting this financial system, just have a look at in this economic system flow. You can remember the what is economic system, right? So it's a macro perspective. You can think a countrywide or a macroeconomic or aggregate level and see how that works. Now, in the slides, you can see and you can recall your high school economics. So, in a basic economic system, there are two players basically. One is households, other one is firms. So, households, they have production factors. When you say production factors, it can be land, capital, labor, entrepreneurship, all these things, all these resources are with households. So firms hire them. They get these production factors from the households. And they utilize those production factors and produce goods and services. Then what happened? So then these firms sell those goods and services to household sector. So this is one way of flow. That means production, like production factors following from households to firms. Then firms provides the goods and services to households. The other leg, you can see when these firms get these production factors, they have to pay for this. So they may be paying interest, they may be paying labor cost, they may be paying profit. So one side, they may be compensating to these production factors through payments. If you can see my presentation, send me a message saying yes, so I can continue. All right, thank you. Okay, now as I explained, you can see Now these households giving production factors to firms, and firms pay for that. It can be rental, it can be profit, it can be labor cost, they will be paying to households. So then these firms produce goods and services and sell them to households. Then the household should pay to these goods and services to firms. Now you can see in the picture, like in addition to these households and firms, there's a government as well. It's a little bit enlarged status of the economic system. But you can see here, like still, now there are payments. The firms paying to household for their production factors, and other side, households make the payment to the firms for purchasing goods and services. So now you can see there's a payment flow as well, finance flow, as well as goods and services flow and production factors flow. So this is the economic system flow. It's always working continuously, right? So going through this cycle, the global economy generates a flow of production in return for a flow of payments. You got that idea? Okay. So always any analysis should be linked to this flow. So this circular flow of production and income is interdependent. So you can see now that when the production happens, then the income also generated. So, and this is interdependent and never ending. This is the economic system. So here you can see one leg, it's a production services and factors, another leg is the payment. So if you want to make a continuous economic activities effectively happening, so then there should be effective payment system. Got it? Okay. So in this picture, you can see, right? I have simplified that version and put it here, right? So now households and firms, you can see, right? As I explained, there's a flow of incomes and then flow of expenditures for consumption and taxes. So you can see there's a payment flow continuously. So then the problem comes here. Do we need to have a financial system to make this happen? A proper finance system to make this happen. Let's assume like, suppose you want to start a business to develop iPhone app, but you have no startup funds. You are out of funds. So as an example, at the same time, there's another person, right? He has the money or maybe retirement benefits. So she has the money, but no investment idea. But there's another person. She doesn't have money, but she has better idea, investment idea. But the problem is how they get into this business together, how they can meet each other, and how they can work out this business model. Right? So one thing we know, there's two people now. One is with surplus fund, other one is deficit fund. In this, theoretically, we call it deficit unit and surplus unit. How they can meet and get together and do the business, that means enhance the economic activities. That's the question. So then we have surplus unit, as I said, servers of funds available for lending, and deficit unit, that means borrowers of funds for capital investment and consumption. So two parties we should have. Then there should be a market, right? So market facilitates to bring these two opposite parties, that means surplus unit and deficit unit, together. And for them to exchange their resources, the market facilitate and then establish a rate of exchange. That may be prices in this case, right? So we should have like if the payment flow should follow properly, then we should have a mechanism to handle that. If you want to have that mechanism, so we should have surplus unit, deficit unit, market, and in addition to that, there should be some financial instruments. Because like a one party should issue a financial instrument to acknowledge her financial commitments to that instrument holder. That means specifying future cash flows. So that kind of financial instrument should be in place to do these two parties get together and do the business. And next, there should be a movement of funds through financial system. So if the like two parties get together and exchange their financial flows, so there should be a movement of funds, right? So then only they can have these financial instruments. So now exactly what we discuss is, if you want to have a payment system flow into economic system, if that is to be formalized, you should have several components. What are those? As we discussed, there should be some surplus unit, deficit unit, there can be markets, there can be financial instruments. So there should be a system to make the funds flow. So we have to put all together to make this economic system workable. Is that okay? Yeah. So that's what finally what we need is a financial system that consists of financial institutions, financial instruments, and markets facilitating transaction for goods and services and financial transactions. So now the problem is, when you have a financial system, you can avoid or overcome difficulty of double coincidence of bonds. So if several people get together, several deficit units, several surplus units, so they can have their transaction without any problem, so they can find their preferences in the market. So finally, if there's an economic system, if that is to be workable or properly executed, so we need a financial system. Is that clear? Any question? Okay, you can see this chart. As I explained, now one hand we have suppliers of fund, that's a surplus unit. Who are they? Again, remember yourself, the economic system. Who are the people in the economic system with surplus fund? When we started discussion, we said like households, they are giving production factors, and firms taking those production factors and they are producing goods and services. This is what we discussed. But in reality, who are the surplus units or suppliers of funds? Or in other words, lenders. Those lenders can be household, so that means their savings, household savings, or maybe companies. When you say companies, it can be a profit, or governments. So when you say governments, they are budget surpluses. That can be surplus units, right? If the budget is surplus, so then they have more fund to lend, right? So maybe rest of the world, if you are like open, if you are going to talk about open economy, now up to now we talked about closed economy. Now if you are thinking about open economy, rest of the world, they can have surplus funds. So these surplus fund holders, they can lend through financial market. To whom? That to deficit unit. The deficit units can be, or we can call it demanders of fund. Who are they? Or we can indicate as borrowers. Who may be the borrowers? Same people, households. So if households are like a sort of fund, so they can borrow. Or maybe companies, if they want to have more investment, of course, if they don't have internal capital, so then they can borrow. Or maybe governments, if they have budget deficit. So if a development, if a government is a development oriented one, so they can have a deficit budget and they can fund through borrowing. So then government can borrow. And then rest of the world, or maybe country to country. Some countries are having deficit budgets, so they can borrow from rest of the world. So they may be receiving funds from lenders. You can see two flows. One is a fund flow, other one is a financial instrument flow. Now borrowers, they issue financial instruments, and lenders, they receive financial instruments. Is that okay? Uh, if there's anything like you can send the message clearly. Some of the messages I couldn't, it's not with very much clarity. So then if you have any questions, please send the message. So then ultimately, you can think of financial system now. The financial system is a collection of components which are markets, institutions, instruments, laws, regulations, and technique and infrastructures. So when you say a financial system, just think, if there should be a fund flow between surplus unit and deficit unit, what are the components we needed? We need financial markets. We need financial institutions. We need financial instruments. We need laws and regulation to control this financial system, or monitor, or like maintain stability of this financial system. We need laws and regulations. Or we need techniques and infrastructure, maybe payment infrastructure. If you want to make payment to deficit unit to or surplus unit to deficit unit. So this collection of all components creates a financial system through which the bonds, stocks, and other securities are traded. Now you know what is financial system. And through the financial system only, the bonds, stocks, and other instruments are traded. And because of this financial system only, the interest rate are determined. Interest rates are determined based on this financial system activities. And through that, financial services are produced and delivered around the world. So now you know what is economic system, what is the payment flows in that economic system, and then we need a financial system to have a effective payment flows. Now you know what are the components in the financial system and how that helps to achieve the objective in an economic system. Is that clear? Okay, fine. Now, just for a understanding, I have given a data sheet here. The total assets of financial system in Sri Lanka. Now, based on this, you can see what are the key elements in a financial system in Sri Lanka. Now you can see in this chart, this table, this is coming from Central Bank of Sri Lanka's annual report 2019, and in page 266, you can see this table. If you take this table, you can see the categorization. The first one is banking sector, and second, other deposit-taking financial institutions, and third, specialized financial institutions, and fourth, contractual serving institutions. So these are the categorization of Sri Lanka for these financial institutions. And based on their assets, this is the aggregate amount of those assets. Now you can see the banking sector in 2019, it's merely 14 trillion rupees. The total assets of banking sector in 2019 is 14 trillion rupees. And other deposit taking financial institutions, that is 1.6 trillion. And specialized financial institution, that is only 282 billion. And contractual serving institution, that is 3.7 trillion. Right? Why I'm showing this is you know the gravity, now you know the gravity of the banking sector. In Sri Lanka, when we say a financial system, we heavily rely on banking sector. So now the banking sector, you can see the share, it's 71.6% of the total assets belongs to banking sector. That's what in Sri Lanka, when we talk about financial system stability, we always talk about banking sector, because banking sector is the one carrying whole burden of this financial system. They are the people, like bank sector is the only sector or like key sector contributing or supporting or facilitating the financial products and services to needy businesses. When you say banking sector, you can see three types of banking institutions. One is central bank, other one is licensed commercial banks, and licensed specialized banks. So three types. So out of that, if you see the licensed commercial banks, LCBs, are the key players in that banking sector. Their assets are like 54.3%. Clear? Out of total financial assets. And when it comes to other deposit taking financial institutions, it can be finance companies or cooperative rural banks or thrift and credit corporations. So you can see those. Only finance companies are material one compared to others. And when it comes to specialized financial institutions, that can be leasing companies, or primary dealers or stockbrokers or unit trust or venture capital or that kind of institutions. So you can see the significance of those institutions' contributions. When it comes to contractual serving institutions, you can see especially insurance companies and EPFs and others. So EPF is a key one under contractual serving institutions and then insurance companies. So this is the total assets of finance system. When you glance through these details, you can understand how important is the banking sector. This may be vary from country to country, but when you take this Sri Lanka, this is the pattern. Clear? Now you know what is financial system and what are the major players in Sri Lanka. In addition to that, I want to distribution of banks in Sri Lanka as well, right? So you can see it's as of 2019, total number of licensed commercial banks are 26. Our total number of licensed commercial banking outlets is 6,690. When you say outlets, it can be branches, it can be student serving units, right? And then you can see the ATMs as well. And then the same details are given for LSBs as well, right? So this also will give you the density of banking outlets in Sri Lanka. So what I want to say in overall, now you can see in Sri Lanka, so banks are well established and contributing to the economy in full scale, and same time their distribution also very high compared to other countries like especially South Asian countries like in Sri Lanka. The financial system is very sophisticated and very strong. Okay, this is for kind of idea what is in Sri Lanka, right? Okay, next, now up to now what you have seen is what is economic system and what is financial system, and then some important aspect about Sri Lankan financial system, right? Okay, then as per this agenda, next what I'm going to discuss is the functions of the financial system. Now, when it comes to function of a financial system, the basic thing, the financial system channels funds. That is very important thing. When we say channeling funds, it's a fund flows from person or business without investment opportunities to one who has them, right? So the finance system facilitates to fund flow from the person who has no investment plan to the person who has investment plan. So basically the fund flows from lenders or savers to borrowers, spenders, right? This is the key function. When it happens, so then that improves economic efficiency. You should be able to now understand why we talk about economic system, because like in an economic system there are so many deficit units, there are so many surplus units. Now the problem is to whom to lend. That's the question. Because without a financial system, if somebody is going to like take this um, several decades back or like centuries back. So there was some barter system. So you exchange product to product, right? So after some time you were lending to each other. That's a direct one. If somebody has excess funds, if they want to lend to somebody else who is having an investment plan, but we don't know how that will be successful or fail, or nobody knows. Then you can't allocate your fund optimally to a business plan. But when you have a financial system, proper financial system, the fund will be allocated optimally, and that minimize wastage, that increase efficiency of usage of finance resources. So through that, so financial system improves economic efficiency. Now you can see this is this some of these pictures are extracted from the book I referred. So already you know, so you can go through those as well. So now when you see these functions of financial system, you can see here two kinds of financing. I'll be anyway elaborating later just for the sake of understanding, right? So the lender server, they can directly finance to borrower spenders through financial markets. We already discussed who are the lender servers, and we discussed who are the borrowers and spenders, and the lender servers can fund through financial markets to borrower spenders. That we can call it direct finance. At the same time, the lender server can fund through some intermediaries or financial intermediaries to borrower spenders. So that is we call indirect finance. These terms are very important. So I think you should be able to remember those. It's a meaningful one. So that called indirect finance. So when you have this kind of setup, you, this lender or saver, inject their funds to financial intermediaries. So the financial intermediaries, they are expert, they're having expertise in identifying which one is better business plan or investment plans, which one will give you a better return. So they know, they have expertise on that. So these funds will be allocated optimally among these investment plans or business people. So now you should be able to understand what I was explaining. Now, what is the benefit of efficient financial system? When you have a financial system, if that financial system is efficient, that gives you several benefits compared to inefficient finance system. Some countries, there may be inefficient finance system, right? So if you have an efficient finance system, that give you numerous advantages. The first one encourages savings. As I explained earlier, now you think like, okay, somebody is going to like, okay, surplus unit is going to give their fund to the deficit unit through financial intermediaries, right? Now, financial intermediaries, as soon as a bank, I have surplus fund, right? So I'm a household, I have a saving, I'm going to deposit that money into the bank. So bank is going to screen better investment opportunities, then lend to them. When the bank like lend those better business opportunities, the bank can earn better return. When the bank can earn better return, so they can pay me a better rate for my deposits. So when the finance systems give me a better return, I would be encouraged to serve more because I'm getting better return. But if the finance system is not efficient, so inefficient finance system, they will pay me only less amount or less return. So I think, okay, why should I serve? Because I'm getting not sufficient return. So then why should I serve? So I don't serve. I just would like to consume more at the current period rather than serving for future consumption. Okay, what does it mean by serving? I sacrifice my current time, I get today's consumption, and postpone that for future consumption, right? That is serving, right? So if nobody is offering me a better return, why should I postpone my consumption? I can consume today's. So the efficient financial system encourage savings. And then, as I explained to you, our savings flow to the most efficient users. The banks, they screen properly, and then they find who is the efficient user, and then they lend to them. So the saving flows to the most efficient user. And third, when you have an efficient financial system, you can easily or effectively implement the monetary policy of governments by influencing interest rates. So we can, in detail, we can discuss this monetary policy implementation. But for time being, you should be able to understand the central bank, the monetary authority, has the obligation to safeguard the value of the currency. So how they safeguard? They manipulate interest rate or money supply. Through that, they wanted to achieve their objective. They influence money supply, they influence interest rate, then they try to achieve their objectives. So this influencing is going through financial intermediaries, especially banks. So when you have an efficient financial system, the monetary policy transmission mechanism will quickly transfer to the end users or consumers, investment or businesses like that. A quickly transmitted to the um, economic activities. So when you have an efficient financial system, so you will have an efficient or effective implementation of monetary policy. And same time, when you have an efficient financial system, the combination of assets and liabilities would comprise the desired attributes of return, risk, liquidity, and timing of cash flows. Right? So return would be determined effectively. So risk would be managed and liquidity would be managed properly, and timing of cash flows will be estimated effectively. So when you have an efficient finance system, these are very important benefits you will have. Is that okay? Any question? Okay, so then up to now we have seen the functions of financial system and their benefits. Next, now you can remember again the components of financial system. The very first is financial institutions. So next we are going to look at financial institutions. Now you can see in the screen, what is financial institution? The financial institution permit the flow of funds between borrowers and lenders by facilitating financial transactions. But there are so many financial institutions in the financial system. We have seen in the annual report extract, the table I show you, the total assets of financial system in Sri Lanka. You would have seen so many financial institutions. How do you categorize those financial institutions? Normally, globally, the financial institutions are categorized based on two important aspects. One is sources of funds, other one uses of funds. If you take a balance sheet of bank, you may be knowing, right? The balance sheets of bank, it's significantly different than a normal balance sheet. You can see in the balance sheet of bank, if you see the asset sides, there'll be different order compared to normal balance sheet of an institution or like a manufacturing or retail company. So here in a balance sheet of financial institutions or special banks, you can see the balance sheet items are ordered asset side based on the liquidity. So starting with cash, highly liquid assets are on top and highly illiquid assets are on bottom. That's the way. So in a balance sheet, you can see the asset size, that is uses of funds. How that institution has used their funds to several assets. And other side, liability side, that's the sources of funds. How a bank get the funds for its business, right? It can be capital fund, it can be from borrowing, it can be from deposits. So various ways of funding. Same time, various ways of use of funds. So the financial institutions are categorized based on source of funds and uses of funds. We should be able to understand and distinguish these financial institutions. Now you can see the first one under financial institutions, we can see depository financial institutions. If you take some institution that attract or mobilize savings from depositors and investors. So some institution, financial institutions, they get the funds as deposits and provide loans facilities to borrowers. So they mobilize deposits and lend to the borrowers as loans. This is one type of financial institution, which is commonly called depository financial institutions. You can think of commercial banks. They take deposits and use that. So source of fund is deposits and use of fund is providing loans. Those kind of institutions, we call it depository financial institutions. And second, you can see investment banks and merchant banks. This also can be called money market corporations. It's merely with US terms as well. So then you can find similar institution everywhere. So what these investment banks are doing, so example is Lehman Brothers, no more, you could remember. So these investment banks mainly provide off-balance sheet transactions to corporations and governments, right? When you say like off-balance sheet transaction, it can be underwriting, it can be guarantees, right? Or they support for mergers, acquisition, portfolio restructuring, finance, and risk management. Those kind of bigger level financial services, right? Some extent they also provide some funding, but their main focus is on off-balance sheet items and especially advice on mergers, acquisition, portfolio restructuring, and bigger picture. So this is we call investment banks. Is that okay? And third financial institutions, we used to say contractual serving institutions. You also have seen in that table, there's a category called contractual service institutions. What do they do? The contractual serving institution, especially the liabilities of these institutions, are contracts that specify in return for a period of periodic payments to the institution will make payments to the contract holders if a specified event occurs. So these contractual serving institutions will be getting fund periodic payment from the holders, contract holders, and the specified event according to the contract and the specified event occurs, this contractual serving institution make the repayments. Now you can think of EPF. It's a contractual serving institutions. So members of that provident fund will be making periodic payments, monthly payments to this provident fund. And when according to the contract and specified event occur, so then maybe after 55 years, if you can get the money or after retirement, so you can claim from them, they will make the payment. If somebody is going abroad permanently, they can claim. So as per the contract, if any specified event occurs, they will get the repayment. So that is called contractual serving institutions. So how these contractual serving institutions are earning, how they earning is like they use this payment from their members to purchase both primary and secondary market securities. They can invest on treasury bills, treasury bonds, they can invest in stock market. Through that various investments, they earn money and they pay back to the members. This kind of institution we call it contractual serving institution. Next, finance companies. Normally, the funds are raised by issuing financial securities direct into money market and capital market. So if you take a finance company source of funds, that is specially they raise the money through money market and capital markets. But here in Sri Lanka, even they can mobilize the deposits. But in a general term, the finance companies get their fund through money market and capital market by issuing financial securities. And they also can make loans to ultimate borrowers. So use of fund is making loans, but source of funds, it's mainly borrowing through money markets and capital markets. So it's a different type of institution. So there's another type of institution that is we call unit trust. So where the source of funds coming from investors. So investors can invest in units. So they can purchase units from these institutions. So these unit trust companies, they get these monies from their investors and then invest those money into different or range of products, financial products, investment products. So that might be specified in their trust deed. Based on that, so they will invest and get the return, and based on those return, they will pay back to these unit holders. Is that okay? So now, yes, up to now, we have seen financial institution. What is financial institutions? And what are the types of financial institutions in a financial system? And what is their categorization and what is their importance? Okay, right. So next, we are going to move into financial markets. Now, I just again remind you all, we started with economic system. We saw the important flows of economic system. In that, payment flows are very important uh, to the continuity of the economic activities. So we saw there should be a financial system to support that. And under financial system, we have seen so many components, collection of components. In that, first we saw financial institutions. Now we are going to see financial markets. Okay, now what is the importance of financial markets? As I explained earlier, now you have money. Let's say, assume like you have $1,000. But if there's no financial market, so nothing, so financial markets or financial institution or nobody is there. What you can do with $1,000, you just keep with you. So the $1,000 is not going to earn any return for you. That means you just keep that $1,000 under your pillow and sleep overnight, right? So there won't be any return out of that. But you think if you can lend that money to a carpenter who could use the money to buy a new saw and make production, and they will be making money and they can share some of those return with you, of course, that is better than keeping money idle. So this what financial markets are very important. As I earlier discussed, so financial markets are critical for producing an efficient allocation of capital, right? Allowing funds to move from people who lack productive investment or investment opportunities to people who have them, right? So when you have the financial market, only you can have this flow of capital efficiently, and that will be used effectively. And same time, not only these firms or the people who are using the funds for production purpose, but also the financial market improve the well-being of consumers, allowing them to time their purchase better. Now let's, as I discussed earlier, right? You think like, now I have the money now, right? So I don't have any financial markets to invest. So I can't defer my consumption. So that means if I'm going to defer my consumption, I'll be loser, because like uh, if you take the time value of money, right? Money is the value of money today is greater than the tomorrow, right? So always I try to consume today. But if I can earn better return, I can time my purchases better. I can have that money for some time, and in future I can make purchase. So this financial market allow me to improve my well-being, because like after not buying today, so maybe after 5 months I would be able to buy and use it, that may be giving a better well-being, right? So not only investors but also for consumers, the financial markets are giving better opportunities. So financial markets also facilitate us to match our preferences. Now, example, let's assume like I just want to buy some inventories for my business. right? But the problem is, like, there are people who can lend me for 5 years, okay? But I need it for inventory. That means after selling this inventory, so I can settle the loan. But I cannot match with the investors' preferences because they need to lend for longer terms, right? So, but when the financial markets are in place, they match. So there's a matching principles, right? So now what they can do is they can give me overdraft to buy my inventory. Same time, the financial market can support to finance longer term assets with longer term liabilities. Example, if you want to buy equipment, they can fund that equipment by debentures or maybe commercial papers. Or financial markets will support that. So they will facilitate this matching principle. So these are the very important facts of an financial markets. So where we need financial markets to handle these kinds of needs and wants. Okay, so we know what is financial markets. We know what is the importance of financial markets. And there are different types of financial markets based on their functionalities or different names, right? So the same market can be given different names based on their functionalities. So you can get to know about some of the names, how we are calling that, why we are calling that, and for your understanding. So just I'm giving a few a very short introduction to some of the markets. Some of the markets we call primary and secondary market transaction. Some of the markets we call direct and intermediated financial flow markets, or wholesale and retail markets, money markets, or capital markets. So there are several names. So when somebody talk about money market, you should be able to understand what about that market, what are transaction happens in that market, why that market, why is that market needed, right? So I'm just going to give some essence of these markets for your understanding. First of all, the primary market. When you say primary markets, the issue of a new finance instrument to raise funds to purchase goods and services or assets. So, a market where a new financial instrument is issued, that's a primary market. The first time issuance to raise funds to purchase goods or services or whatever it is, right? So the first time issue, that is we call primary market. These financial instruments can be issued by businesses or governments or individual. It's okay. So when it comes to businesses, that can be a company shares or debentures. Or when you take governments, it can be a treasury bills or treasury bonds. Or if you take an individual, that can be a mortgage. So when it comes to primary market, so that is the primary market where you get a new finance instrument as it is. Is that okay? But when you see the secondary market transactions, the transaction you can see in the secondary market, that's the buying and selling of existing financial instruments, right? In a secondary market, the buying and selling can happen. That is for existing finance instrument, not a new instruments. Okay, now assume like I'm going to buy a share directly from a company. Like there's a IPO, right? Initial public offering. There's a company A, is issuing to me, right? So I'm going to buy that one. That's I'm going to buy in a primary market directly from the company, right? I bought now, right? That's a primary market purchase, a new instrument. Now, right, I'm going to sell it to that shares to another person. That will be a second, not a new instrument. That's a second time transaction. That will be happening in a secondary market. So now when I'm going to sell that shares to another person, there's no impact on the original issue. Let's say company A is not going to lose their money, or they are not going to have any fund flow. The fund flow will happen between me, the first time purchaser, and the second person. That's what I have mentioned, no direct impact on original issuer of security, right? So transfer of ownership from one server to another server. So earlier, first time I bought, I was the server. Now I am going to sell it to another server. He is going to buy that security. So there's no direct impact on original issuer and only transfer between two servers. But the secondary market transactions are very important because that provides liquidity, which facilitates restructuring of portfolio of security owners. Now let's assume. Now I believe that when I buy this company shares, I believe that, okay, if I don't want, or if I need money, I can sell it in secondary market, maybe Colombo Stock Exchange. List my shares there under company name, and then I can sell it at any time. So I can get liquidity. Let's assume if it is not saleable at a secondary market, that means if there's no secondary market, there won't be any liquidity facilities. So if I want to sell that, I can't sell it. So if I can't sell it, sometimes I don't buy it then from the initial issuer. So the secondary market provide liquidity. Through that, I can restructure my portfolio. So I can sell today company A shares and buy company B shares, and sell later company B shares and buy company C shares. So then I can restructure my portfolios. Got it? So primary market and secondary markets are two different names to given for the functionalities which we discussed. Is that okay? Any question? Here you can see in this picture. Now, direct financial flows, right? Now, up to now we have seen primary and secondary market. And then as I discussed, there's another types of markets, we can call it direct and intermediate financial flow markets, right? So it's the second time. So as we see in this screen slides, what do you mean by direct financial flows? Suppliers of funds, right? Directly dealing with users of funds, provide funds, and then users of funds give financial instrument to suppliers of funds. This is direct, no intermediary between. We directly suppliers of funds or suppliers of funds, surplus unit, directly funded to deficit unit. There's no intermediaries. That is direct funding. So for that payment, the deficit unit gives the financial instruments. Right? So sometimes maybe you can see brokers or dealers in between. but the transaction directly happened between surplus unit and deficit unit. That is the direct financial flow. As I explained here, borrowers borrow directly from lenders in financial market by selling financial instruments which are claims on borrowers' future incomes or assets. Right? So when it comes to initial public offering, that's a direct financing. You can see the examples. A household which buys a newly issued government bond through the service of a broker. When the bond is sold by the broker in its original state. Now, here, like in Sri Lanka, we have primary dealers, so they will buy directly from government, and then they sell the government securities in secondary market. But some of the markets, the household can directly buy government bonds through brokers. Right? When the bond is sold by the broker in its original state, so that is direct finance. Right? A business which directly buys newly issued commercial paper from another business entity, that's a direct finance. So here what we have to see is what is meant by direct finance. The borrower borrowed directly from lenders. Is that okay? Now, there are advantages as well as disadvantages as well. Now, when you directly borrow, you can avoid cost of intermediation. Now, if you're going to borrow through somebody, maybe intermediary, take as a bank, so they get the fund from the public maybe as a deposit at 8%, and they will lend it to you at 12%. So there's a 4% margin, the depositor also losing and borrower also losing. So if you are going to have this direct borrowing, then there won't be any intermediaries. So then you avoid cost of intermediation. Is that okay? Right. And the advantage is increased range of securities and markets. Now, if somebody is going to directly deal with, so you have to design your financial instruments according with the borrower's expectation and lender's expectation. So all these borrowers, lenders' expectations are totally different. So you have to design so many securities, so many range of securities, and you may be having so many different markets based on those needs and wants. And same time, there may be disadvantages as well. The first, matching of preferences. It's very difficult to find a person who can lend to me based on my preferences, and that should be his preferences as well. So it's very difficult to match those. And then if it is a direct financial flow market, so like direct borrowing, so then the liquidity and marketability of that security is very, very hard or difficult. Let's assume like somebody is, I'm just lending to somebody and he is giving a commercial paper to me. So can I give that commercial paper to somebody else and borrow as a mortgage or whatever security? Or can I sell it in the market, that commercial paper? No. If it's a direct one, it's one-to-one. So then you don't get a high liquidity or marketability of that security. And third disadvantage is search and transaction cost. If I'm going to deal with directly with a person who can lend to me, I have to search first. That's a searching cost is high. So finding a person is very difficult. And then transaction cost, you have to go to lawyer. It's in simple term, you have to get a lawyers and so many experts inputs and sign the agreement for a small transaction. You have to do all the things. So transaction cost is very high. An assessment of risk, especially default risk. If I'm going to lend directly, Because there are so many people deficit unit in the market. They will say, okay, I'll pay this much, 10%, 13%, and I'll do the cash flow like this. How do we assess? How do I know he has less risk or high risk, or he will not default? He will repay according to our agreement. How can I ensure that? That's a big question. So assessment of risk, especially default risk, is very difficult. So in a direct market, so you have advantage, but at the same time, you have disadvantages as well, right? Okay. Next, you can think about intermediate financial flow market. So indirect market. In this indirect market, you can see this picture. In this indirect market, the two parties are there, surplus unit and deficit unit. But they don't do the transaction directly. So deficit unit is not going to borrow directly from the surplus unit. They borrow through intermediaries. That means surplus unit park their fund in intermediaries. Then intermediaries lend those funds to deficit unit. Here you can see the difference. The deficit unit will have the contract with intermediaries. Let's assume intermediaries are the banks. So like banks get the deposits and lending to a customer as a loan. Right? If you take the surplus unit, those are the depositors. They park their money in this bank as a deposit and get their deposit certificate. So financial instrument here is deposit certificate. That is a single contract. So bank and the surplus unit depositor will have a separate contract. And then the intermediary, that means bank, will lend those funds to deficit unit. That's a loan. So then this deficit unit will have an agreement with this bank, loan agreement. That is a financial instrument. So here in an indirect market, so indirect financial flow market, you will have two separate contracts. That means surplus unit with intermediary, and then other one is deficit unit with intermediary. So this is indirect. Is that okay? Any questions so far? As I said, when it comes to indirect finance, borrowers borrow directly from lenders via financial intermediaries established to source both loanable funds and loan opportunities by issuing financial instruments, which are claims on borrowers' future income for assets. Right? I always say that which are claims on borrowers' future income or assets, because that instrument or like agreement is going to say the so and so will be paying monthly 50,000 for next 5 years. So borrower's future income, you are going to claim from borrower's future income or assets. So example is always for indirect financing is a bank loan. As I explained earlier, the intermediate flow market. Now we know like direct and intermediate finance flow, how that happens, what is direct and what is intermediate financial flow. And this intermediate flow market, as I explained, a financial arrangement involving two separate contractual arrangements, right? Whereby server provides funds to intermediary and the intermediary provides funds to the ultimate user of funds. There is that clear? Yes. Now you can see the advantages of this intermediate flow markets. The first one, this if you see this overall, especially this has the advantage of assets transformation. The assets can be transformed into various characteristic. The first one, the maturity transformation. Let's assume a bank example is given. A bank borrows funds from many persons. That means bank is mobilizing deposits for short term. Then it purchases a bond with 10-year maturity. Now that is maturity transformation. Now let's assume like I'm having money, so surplus unit. I want to invest that money, but I need that money within 1 year's time. But can I buy a 10-year bond? No, because I need the money back in 1 year's time. But banks, what they can do is they can mobilize the deposit like this. Maybe if my one is from 1 year, my other one is from 5 year, 2 year, 3 months. They borrow all these short-term funds and all, but purchase 10-year maturity bond. And they arrange their future cash flows accordingly to settle whoever wants their deposits back. So then, even though they borrow short term or they get the deposit in short term nature, but the maturity of those funds transform into 10-year maturity or 15-year maturity, maybe 5-year maturity. That can be done through this intermediate function, right? That is one thing. And not only maturity transformation, there can be denomination transformation as well. Now let's assume like there's a security that is $10 million worth of security, but I have like let's assume $1 million. I can invest on that. But bank, they can do that. They can buy the $10 million and they slice it into different pieces and sell them, right? So small deposits they can make. Just I am linking with banking business, so they can because it's a better understanding, so they can get small amount of money and then they can invest those money deposits into a big amount of investment securities, right? So denomination transformation also will happen in an intermediary market. And not only that, and risk transformation, right? Now as I said earlier, like I deposit my money into the bank and they wanted to lend those, and they have several business owners or borrowers, and their risk appetites are different. So they price according to their risk appetite. Maybe like if somebody is not risky for 2% interest rate, somebody is risky 5%. So they get maybe 3% interest rate. They get the money from me at 3%, and they can like transform that risk into different categories. If there's no risk, okay, they can give at 3%, and somebody is having higher risk, or they can lend to 5%. So they do the risk transformation as well in an intermediary transaction. So those are very much attractive compared to direct transaction. Not only that, and same time, the credit risk diversification. So bank can do the diversification. Now let's assume like I'm having like 1 million rupee. If I'm going to lend to a carpenter, so he will be utilizing my 1 million money to that only one business, right? So if something happened to his business, I don't get the money back. But with the banks, if they can lend their money into different sectors, maybe government sector, maybe I deposit my 1 million rupee into the bank and they will lend to those monies into different sectors. They collect all these depositors' money and lending into different sectors. That may be agriculture sector, that may be a manufacturing sector, so that may be a different like sectors, right? Industrial sector, so whatever it is. So if one is performing bad even, so other sector will be performing well, so they will be mitigating those credit risk through diversification. So that cannot be done in a direct lending. And other one is economies of scale. Now I am a surplus unit. I have only little money. I want to lend to somebody at direct lending. So I have to search a person. So there may be transaction cost, searching cost, but so many costs I have to involve. So I have to spend my time and all these things. But bank has already a system in place, so they don't need to like bother about this small piece of contracts and all. So they can do it at a very low cost at a less time. So economies of scale is very much applicable to this intermediate financial market rather than direct market. And also, like I would like to mention other one like sectoral flow of funds. Now, when it comes to like indirect market, so then the funds can flow into between so many sectors, maybe businesses, financial institutions, governments, household sectors, or even rest of the world. So that can flow into any sectors. But if I'm going to do direct lending, so I can't do that. The most specifically, like you also think of um, just for a notification I have given here, this intermediary lending is always influenced by fiscal and monetary policy because there's an intermediary, so that is heavily affected by monetary policy and fiscal policies. So this intermediary market is always open to that kind of exposures, right? Okay. Under this direct and intermediary market, right, we can think of something else as well. Another reasons for financial institutions for its existence, it reduces the impact of asymmetric information. What do you mean by asymmetric information? Let's assume there are two parties, right? Simple example, we'll go for a car sale, right? I have a car. I'm going to sell my car. There's a person to buy, right? Who knows better about the car? Actually, the owner of the car is having more information about the car than the prospective buyer. The owner of the car knows exactly what's the problem inside the car, whether it's good or bad, what are the repairs to be done. So everything's known by owner of the car. But the buyer of the car just go around, right, and see the car, whatever the stories, he listened to whatever the stories given by the owner of the car, but he can't get the exact information, or he can't have the all the information, whatever the information available with owner of the car. So here, this is called information asymmetry, right? This is called information asymmetry. That means one party lacks crucial information about another party. So then you can't take an optimal decision. Because if I'm going to buy the car without knowing exactly what is the worth of that car, I'm going to buy it because I have miss some crucial information, or owner is not going to tell that information anyway, right? So that is there. So in this information asymmetric problem, we can discuss in two fronts. There are two names given to those two fronts. One is adverse selection and other one is moral hazard, right? This is a huge area, but anyway, we are not going to talk about too much on that, but you should be able to know or understand the concept behind that. Why financial institutions exist, right? Why banks, why do we need banks actually, right? So because the main reason is it reduces the impact of asymmetric information. Okay. So in this asymmetric information problem, I said like we can discuss with two fronts. One is adverse selection, other one is moral hazard. What is adverse selection? The adverse selections means by having insufficient information. That means I don't have sufficient information. That means with that available limited information, I am going to select the business partner or the opponent or party who wants money from me. I am going to choose with limited information. So with that limited information, that selection may go wrong or may go adverse. So selection process itself that may go wrong because of what? Information asymmetry. So this, when we say adverse selection, it's always happens before transaction occurs. Okay, so you can think now potential borrowers most likely to produce adverse outcome are ones most likely to seek a loan, right? You can think like if somebody is very strong, they have financially very strong, they have enough cash flow, they need to come for a bank loan, right? Who is coming for the bank loan? Because they are already short of money, right? They are the one coming for a bank loan. So their credit worthiness or their financial background is already weak. That's what they are coming for the bank loan, right? So if we don't have the sufficient information to evaluate, you may choose a bad person, right? Now let's say some like similar problems occurs in insurance as well. Who seek the insurance? The people who are unhealthy, right? The people who want their non-medical problems covered, they will come. If let's say now somebody is having kind of risk of having heart attack, right? They try to get cover before that happens, like non-problem, but before that happens, they wanted to have insurance contract. So then, because of asymmetric information, I don't know about any health conditions of that person. We might have uh, like get a medical certificate, but still, right? The intention of that person may be getting, right? He may be thinking, okay, it's alarming. Okay, I want to get a insurance policy. So now, because of the information asymmetry, I can choose him because I don't have sufficient information as he said. So the first one is adverse selection. The second one is moral hazard. Because of the information asymmetry, right? Now let's assume I got a car insurance. So I went for a car insurance, right? I got a car insurance. Now I think, okay, I have the insurance. What's the problem? I can take more risk. So that is the moral hazard. So if somebody get the bank loan after the transaction, this is okay. Insurance or bank loan, it's after the transaction. So now bank has granted the loan and disbursed the loan. Now borrower can think, okay, it's not my money. I borrow from bank, so I can use this money for any undesirable activities. So immoral activities. So if that guy can decide, okay, I'm not going to pay back. So I do whatever I want to do with this money. So hazard, the borrowers has incentives to engage in undesirable or immoral activities, making it more likely that won't pay loan back. Is that clear? This is moral hazard. Again, with the insurance, people may engage in risky activities only after being insured. So that's what I said. Like after I get my car insurance, I just do the risky driving, right? So I used to think, okay, I have full insurance. I don't have to worry. So I take more risk activities, right? So this leads to a conflict of interest as well, right? So now the financial institutions reduce this information asymmetry problem, because rather than direct lending, compared to direct lending, the intermediary business, that means if there's a bank in between, they collect more information than an individual. They can have more screening than an individual. They have a lot of expertise than a normal individual. So they try to reduce this information asymmetric problem. Through that, they try to reduce adverse selection and moral hazard. So the indirect or intermediary transaction is better compared to direct one. So financial intermediaries reduce adverse selection moral hazard problem, enabling them to make profit. Because of their expertise in screening and monitoring, they minimize their losses, earning a higher return on lending and paying higher yield to savers. Is that okay? Earlier also we discussed, right? Efficient financial system encourage savings. Of course, this is the way, right? Okay. Okay, up to now we have seen market, that's direct and indirect markets. Next, we are going to see money market. We are going to continue. So I just want to give a 10 minutes break, right? After the 10 minutes break, we can start again. Okay, we can start now. We were looking at markets, financial markets, primary markets, secondary markets, direct markets, indirect markets. And now we are going to look at money market. Money markets, especially a wholesale market in which short-term securities are issued and traded. So you have to understand that the market where short-term securities are issued and traded is called money market. So here securities are highly liquid, and term to maturity, if you see the term to maturity, it's 1 year or less. And then it also is highly standardized form, right? It can be the instruments are like maybe 1 month or 1 day or 7 day or 30 days, so something like that. And rate, so everything is uh, kind of in a formal way, so everything is standardized. So somebody speaking to maybe interbank markets, right? So everybody like knows everybody knows what they're doing actually. So it's every standardized. There's no ambiguities in that. So it's a short term, very short term borrowing. And then here like you can see this also one of the attribute, like you can see like no specific infrastructure or trading place, actually like over the phone the transaction can be done, right? If you think like, okay, bank A want to borrow from bank B overnight, okay, or the phone you can do it, and money will be transferred to their respective accounts, right? This money market enable participants to manage their liquidity. Now let's assume like it's like this. Now like bank A wants some money immediately, they have a due, right? Okay, so they can borrow it as soon as possible, right, through another bank through money market transactions, right? Or like if they want to, like if somebody, some banks may be having excess money, so they may want to park that money for some kind of return, so they can do immediate transactions, right? So this is that's what I have mentioned. There's no specific infrastructure or trading place, just you can do it, right? Okay, that is money market. And then it's a capital markets, right? So here like longer term securities are issued and traded, right? If borrowers and lenders, like they can exchange their funding, right, for longer term, like example equity markets or corporate debt markets or foreign exchange market, government debt markets or derivative markets. So these are longer term. Mostly it's more than 1 year, we call it longer term. So term to maturity is more than 1 year. So this kind of securities, if there is a traded, so we call it capital market. And maybe another categorization may be debt and equity market, right? So that also we can call it. So if you issue and trade debt instruments, that we can call it debt markets. Or if you like issue and trade equity, so then that can be called equity markets. So only you should be able to understand, you might be knowing the difference between debt instruments and equity instruments. Now if you take these debt instruments, you have to pay interest regularly for that borrowing, and end of the maturity you have to pay capital as well. So this can be short term, long term, or intermediate term. When you say like short term debt, it's below 1 year, and longer term is about 10 years. And when you say intermediate term, the maturity is in between 1 and 10 years. So usually we use that term, right? In other hand, if you take the equity instruments, so that dividends are paid for this equity instrument, theoretically forever, because indefinite period, that investment is for indefinite period, so then dividends are forever. But same time, like if the bank, if the institution or companies are making losses, so you may not be getting earning dividend as well. But here like the major difference is like ownership claim. So the equity holders, they have the ownership claim. So now as an example, if a company is going to be wound up, so then after settling all third party claims or external liabilities, the final net assets will be belong to equity holders. That's what the ownership claim means. So they can get that, the equity holders can get that. So that kind of market. Now debt market, now here like you can see this Columbus Stock Exchange and an equity market, and there also we have listed debt instruments as well. So you can see this kind of market. So this is one of the other categorization you can see in the markets. Okay, now up to now, we have seen financial markets, and then we are going to see now financial instruments. Okay, so when it comes to financial instruments, so there may be so many instruments that can be equity instruments, that can be debt instrument. So there can be other financial instruments, maybe derivatives. So we should be understand those instruments in a simple way. Anyway, you will be discussing in a detailed way in coming lectures maybe, right? So here, like when I'm giving this overall idea of financial system, you will be getting some idea about these instruments as well, because like that is one of the component in a financial system. For an introductory purpose, you will be getting information on that. So first, when you talk about financial instruments, one is equity, right? So the equity means ownership interest in an assets, right? So if you take a company, right, a business entity, so equity holder has the ownership of those companies' assets. Special residual claim on earnings and assets. So that means like when the company earns, like they have to pay for their debt holders and all these things. After that, so that earning belongs to these equity holders, and then the net assets as well, right? So that's what we always say, like residual claim on earnings, that is dividend, and residual claim on assets on liquidation, right? Okay, so then type of equities may be, there may be several types, like one important types, you can call it ordinary share. Another one is hybrid, quasi equity, security. So when it comes to ordinary share, this is the normally in Sri Lanka, most of the companies are having ordinary shares, right? Only few of them having preference shares or convertible notes, right? So ordinary share means like, okay, that is the whole residual claims are belong to that ordinary share. There's no change in the contract, right? But hybrid share, when it comes to, so when I say like equity, so then they have the voting rights, they have the rights to claim from the earnings and assets. But when it comes to preference shares, right, it has like partly equity and partly debt. That's what it calls hybrid, right? So you can convert like convertible notes. You can now that act as a debt instrument, but you can later period you can convert into equity instruments. So these are, we call it hybrid. But for the claim, like they have the priority now, earnings or like liquidation time, so they have the priority now. Preference shares in the earning, they'll be getting dividend, right? Provincial different, right? So these type of equities are one of the key instruments in a financial system. And financial instruments, right? Next one is debt, right? So I saw, like we discussed about equity, and now we are looking at debt. So when you say debt, it's a contractual claim to periodic interest payment as well as the principal. As I said earlier, like when you have a contractual claim, right? So if you go for a debt, right? So then the interest, regular interest should be paid as per the contract, and end of the at the maturity. So then you have to pay back the principal as well. So as I discussed earlier, this is ranked ahead of equity. That means in a time of liquidation, right? This debt holders should be paid prior to settling these equity holders. So they always ranked ahead in a residual payment. And then this debt can be secured or unsecured. Now, let's say like one company is issuing a debenture, right? That's a debt instrument. And when you issue a debenture, so then that can be a secured debenture or unsecured debenture, or that the issuer, the debt instrument issuer can pledge that debt instrument with underlying assets. So like they can give security for backing to this debt instrument. So any securities, like there can be assets um, as a security. So that can be issued, and that works like, as I explained, a period interest payment as well as the end of the maturity you have to pay principal as well. So this is debt instrument. And then financial instruments includes derivatives as well, right? Derivatives. So here, a synthetic security provides a specific future rights that derives its price from a physical market commodity, gold and oil, or financial security, interest rate sensitive debt instrument, currencies, equities. So it's when you say derivatives, right? It's a synthetic. You specifically made security, right? Uh, that provide a specific future rights to you, right? That prices derives from underlying assets, right? Let's assume like before going to the products and the derivatives. Now, I just want to say an example, local example, like you can see. Um, Now, these paddy farmers say they produce paddy in a certain period, right? So, but when they produce after harvesting, right, price may be very low. So what the farmers do is like they before harvesting or even before they grow, like they start their farming, right? They go to a buyer, prospective buyer, and say, okay, maybe in March I'm going to harvest this much of paddy, and I'm going to sell it to you. What price you buy? So then the buyer also can quote a price, and they agreed on a price, right? For a few for the paddy, right? That will be available in a future time, right? So then maybe 3 months later. So that underlying assets is paddy, right? So then they are going to fix the price based on that underlying assets and agree today for future transaction. So here, that transaction derived from this underlying assets. That's what we call it derivatives. Clear? So, as I mentioned here, the derivative means a synthetic security providing specific future rights. So, what is specific future rights? So, he is going to buy that paddy, right? And that derives its price from a physical market. So, that means here I have given gold or oil an example. Okay, paddy also maybe physical market commodity, right? Or maybe financial security, like maybe the price of a currency at a future date, right? Or price of equity at a future date, right? So then in future, you're going to buy or sell that product and you agree today, right? So normally this used to manage price risk exposure and to speculate. Now, if you take the paddy example, so why he is going for that agreement? Because there's a price risk exposure. Because like after harvesting, you are going to have, you may have like a very low price. So he wants to mitigate that price risk. So today he is going to enter into that contract, or sometimes speculative purpose as well. Now in a foreign exchange market, if somebody somebody like felt like, okay, this in 1 month's time the local currency is going to um, depreciate so much, so I just buy foreign currency today and sell it later. So that's you can enter into a contract for that kind of transaction as well. So then it's a speculation to earn more in the future. So derivative is used for that. We can see four basic derivative contracts, right? I just want to touch upon those as well. So you should be able to know like what are those four derivative contracts. The first one is forward contract, right? When you say forward contract, this is all related. I'm just um, want to elaborate with regard to foreign currency transactions. So when it comes to forward foreign currency transaction, that's one of the basic derivative contract. We call it forward, right? That contract giving the buyer an obligation to purchase an asset at a set price at a future point in time. So that's a forward contract. Actually, the paddy, the example is a forward contract because future you are going to produce and sell it. Today you agreed for a price, right? Here the three things are very important. One is it's an obligation. Once you enter into a contract, you have to do it. Now, if you promise, okay, I'm going to buy this in end of March, you have to buy that. That's obligation. You have to purchase that assets. And second, it's at a set price, right? You have agreed a price, no more negotiation at the end of the contract, you have to buy that at a set price. And a future point in time, like you agreed for a future time, you have to do it. So it's an obligation, there's a set price, and a future point. So these are the basic idea and the facts of a forward contract. Now let's assume I just want to think about I'm going to import a car from Japan, right? So now I'll be importing end of March 2021. So I have to pay for that. When? End of March 2021. But I don't know the currency price during that time. So I guess like maybe there may be depreciation. So I just wanted to go to bank today itself and fix the price exchange rate so I can buy 1 million yen in end of March 2021. So I go to bank today and say, okay, of course, I need 1 million yen end of March 2021. Okay, can you provide me? So, okay, they will say, okay, we can provide at this price exchange rate. Okay, if you agree, that's a forward contract. So end of March 2021, you have to buy that foreign currency yen at a set price today at that time point of time, right? So you can't say now, no, market is cheaper. Buying this foreign currency in the market is cheaper, then I don't need to buy. No, you have to buy. That is called forward contract, right? The example is forward foreign currency, right? Okay. Then there's another product, derivative products we call future contract. This is similar to forward contract, but a contractual agreement generally made on the trading floor of a future exchange. So there are specific future exchanges. So you can't do that over the counter, these futures. But forward contract, of course, you can go to the bank and do it over the counter. There's no issue. But these future contracts, you can have only in future exchanges to buy or sell a particular commodity or financial instrument at a predetermined price in the future. So the price would be available, and then future contracts also. If it is 10,000 K, you will have 10,000. So okay, $1 million all fixed, right? So you have to choose. So from and you have to buy, you can buy from future exchanges, right? So future contract, futures, it's always a standardized form, right? So that is the difference between forward and future contracts. And other one is option contract, right? We are looking at the four basic derivative contracts. The third one is option contract, right? The problem here is a problem, not problem, it's a benefit. Now, actually, like when you compare to this forward contract, but option contract gives the purchaser of the option the right to buy or sell a particular assets at later date at an agreed upon price. Now let's see. The problem in forward contract, once you get into the contract, you have to fulfill that contract. You have the obligation to do it. But in an option contract, you don't have the obligation, you have only the option. You have the option to buy or sell. So you have the right, right? You can decide based on the market rate, market conditions. Now you enter into a contract to buy foreign currency after 3 months. It's option contract. So after 3 months, you can see whether this is still beneficial for you. If it is beneficial, you can buy it, or otherwise you can leave it without that means you can execute the contract, or you don't need to execute the contract. That is the option given under option contract. But here you have to pay a premium for the bank when you go when you want to enter into the option contract. Is that okay? Okay, next, the next derivative contract, that's we call it swap. Uh, when you see the swap contract, it means that is the agreement between two parties to exchange sequence of cash flows for a set of period of time, right? So now these swaps can be like exchange of two different cash flows, right? Say an example, I would like to say like, okay, uh, I just, there are the contracts can be, swap contracts can be foreign exchange currency swaps, or like interest rate swaps. Okay, different swaps are there, right? I think you, like you will be studying this in detail later, but I just want to give some idea on that. So let's assume like I entered into a fixed interest rate loan, right? And then I'll be paying fixed installment, because interest rate is fixed. I'll be paying fixed installment, right? And there's another person, like let's assume he has gone for a flexible rate, floating rate, right? So then he'll be repaying the loan at a different rate, or that's floating, maybe changing, and cash flow may be changing. But now I think, okay, fixed rate, maybe I just get an opinion, right? So I guess, right? So I guess thinking like, okay, the fixed rate may not be beneficial for me. It's better to go for a flexible interest rate. So I can find a person who wants to get a fixed rate cash flows, and if I find a person like you can do through banks, right? So you are going to exchange your cash flows, saying like, okay, I will pay flexible interest rate, the cash flows, and you can pay fixed interest rate cash flows. So we exchange our cash flows, right? Cash flow sequences. So that is called swap. So what you have to understand is like when it comes to like financials, market. So there are stakeholders with different opinion, different needs, different purposes, different objectives. So they need different kinds of financial instruments, and every time they wanted to change their, um, opinion and guess and speculate, so based on that the ideas changes. So they need sufficient financial instrument to capture their needs. So these are the items, so based on the different perspective it will give different capabilities to the players in the market. So SOP is the kind of a product, right? Okay. Okay, up to now, we have seen financial instruments in a short way, right? I didn't like, because this will be covered in detail later. So then I have given some kind of introduction. Any questions up now? Is that clear or any questions? So if everything is okay, you can send a message saying fine. Or any question? Okay, fine. So we will next, I'm going to move into regulations, right? So as I discussed earlier, you can still recall all these discussions. We started with economic system and the production flow, production services flow, and this production factors flow. Then we discuss about the payment flows into that, and then we discuss about the finance system, how that helps to economic system to continue its activities. And we saw different components in financial system. So we were looking at one by one, institutions, markets, and instruments. And now the other item is regulations. So here, like what I'm going to do is a small kind of introduction will be provided here, right? We can discuss here, and we can discuss in detail later. Okay, now why do we need regulations for this financial system, right? So we can see the main reasons for regulations. The one is increased information to investors. We have seen that earlier, right? The major problem in this financial transaction is information asymmetry, right? The deficit unit and the surplus unit cannot do in a fair deal where the information is not symmetry, right? So always that issue is there. So then maybe for bankers or security exchange commission, so all these regulators, what they do is, okay, they encourage the players in the market to provide more information, right? To get to now, let's take a company you want to invest. So then, like whoever like giving more information, you can enlist more and take a more suitable decision than without information. So like these regulations especially encourage all these players in the finance system to provide more information. So that like support to decrease or reduce the adverse selection and moral hazard problems, right? Like one, the very first is increase information to investors, so that will help to reduce adverse selection moral hazard problem. Now you can see this Security Exchange Commission forces corporates or encourage corporates to disclose information, so they can have annual reports and they can publish information, and banks, everybody publish more information to investors, so then investors can take uh, optimal decision, right? Okay. So second, ensuring the soundness of financial intermediaries. Now let's assume this is directly talking about banks, especially, right? Now regulations actually put forward to this financial institution especially to safeguard their soundness or their stability, because otherwise, like, these finance institutions or intermediaries doing their business based on public deposits, general public deposits, they can take more risky business activities, right? So then, if there's a regulatory framework to cater all these um, manipulations, or like all these risky activities, or they can limit those risky activities, so the soundness of this finance institution may be upheld. So if you have a strong regulatory framework in a financial system, so people won't get, or like stakeholders won't get a panic, so that can be prevented, like when you have a strong regulatory system. And this strong regulatory system can charter or report requirements, or a restriction on assets or activities, deposit insurance, and anti-competitive measures can be taken through this regulatory framework. So you implement or introduce regulations on maybe reporting requirements or asset restrictions, or you can have a deposit insurance. So all will ensure the soundness of the financial institutions. So the regulatory framework is very important for that. And then improving monetary control. We just slightly discussed about monetary policy, right? I touched upon. If we want to implement effective monetary policy, so this finance institutions should be more efficient to cater to those monetary policy implementation. So for that even, you need to have regulations. So maybe one of the item is a reserve requirement. So the banks are required to have reserve, statutory reserve. We call it SRR. So then we can have a proper monetary control. Or maybe requirement of deposit insurance to prevent bank panic. So these are the key reasons to have regulations actually. Okay, in addition to that, I also would like to discuss mm, how, like, when the soundness is ensured, right? There may be like purposes, right, for each and every regulations, right, to ensure soundness of finance system. Normally, like, there are 6 types of regulations to protect the public and economy from financial panic, right? So what are those 6? One is restrictions on entry. Second, disclosure. Third, restriction on assets and activities. Like for deposits insurance, and limits on competition, and restriction on interest rates. So these are the 6 areas. So always regulation is attracted, right? So through this activities, the financial soundness can be ensured, right? These are the principle, right? Okay. Now, restriction on entry. Okay, who can have a financial business? Like example, like if some banks wants to start their business, okay, new bank is going to have uh, their business in Sri Lanka, means example. So then you might have so many restrictions through regulations. That is one. And then if there are existing banks, finance institution, to show their accurate picture of financial profile to the general public and investors, there may be so many regulations requiring disclosures of informations. And restriction on assets and activities. Okay, regulation. If some assume like some banks are taking more risk or are invested on unwanted, undesired assets. So there can be regulations to restrict that assets or activities, banking activities. Or like as I said, like deposit insurance that gives the confidence to general public. Okay, if something happened to the financial institution, even we can get our deposit back through deposit insurance. So those kind of um, regulations should be required to give confidence to the general public. And limits on competition also, we need regulations. So regulations are introduced for limiting competition. Now, as an example, opening of new branches, like regulations can restrict who can open a new branch, which area you can open a new branch, or like you can close down, or whatever the activities. So then limiting on competitions. Okay, if the banks are like high densely populated in the small areas, that also may be not good. So then there may be limitations on that. And restrictions on interest rate. Now, regulation is needed to restrict the interest rate, like some consumer loans may be charged very higher, so general public welfare may be affected based on that. So like regulation can cap their interest rate. Now you can see like credit card interest rate is capped, right? So like that. So then there may be so many regulation based on that, right? So these are the types or needed area for regulation. So most of the regulations are like based on these six types of activities in the market with regard to financial institution. So through these regulations, the soundness can be upheld. Now we have seen why regulations needed, on what area regulations can be um, implemented mainly, right? And then who are the regulatory agencies in a financial system? That differs country to country. Now you can see this is what I have given here is like US regulatory system. It's based on the book, right? So here like different financial, so UK is a huge economy and biggest financial system, and they have different so many financial different types of financial institutions. So there are different types of regulators for regulating these financial institutions and markets. Now here you can see like regulatory agencies and subject of regulations and nature of regulations. Like as an example, now Securities and Exchange Commission is a regulatory agency which organized exchanges and financial markets. The nature of regulations requires disclosures of information, restrict insider trading, right? So you can go through this one like here like now that you can see the third point, like office of the controller of the currency, uh, that is federally chartered commercial banks. So commercial bank, federally chartered commercial banks are regulated by office of the controller of the currency. right? Their nature of regulation is charters and exempt the books of federal chartered commercial banks and imposes restriction on assets they can hold, right? Um, that is very interesting, and you can compare Sri Lankan regulatory framework also. Now, Central Bank of Sri Lanka is a regulator for banks, finance companies, leasing companies as well. And you can see stock exchange commission, right? They regulates brokers, right? So different people are there to for regulation. Even insurance regulatory commission regulates insurance companies. So here also we also having multi-tier regulatory agencies. But as I said in the like earlier slides, our financial system is mostly um, dominated by banking sector. So like key regulators, Central Bank of Sri Lanka. That's we should understand. Okay, now we are reaching our final item for today's discussion. That is impact of globalization. Now we have seen what is economic system, how that works, and what is the importance of financial system, how that helps to economic system to perform, and what are the components in a financial system, and then not only within a country. So the financial system has interdependency with other financial system or economies around the world. So if something happened to a local financial system, that will immediately will have a signals in other financial system and markets, right? So if something happened in a US, so definitely that will affect our financial system, or UK or Europe. So we should be able to understand that interlinkages, right? Okay. Okay, I here like you can see like globalization of financial markets, that refers to the interdependence of national financial system. So when you say national financial system, it's every country has their own financial system. That is called national financial system. But every country's national financial systems are interdependent. Because if I want to make a payment to a car seller in Japan, of course, we have to use the local finance system that is linked with Japan finance system. So our transaction go through these two financial systems. So it's always interdependent. So then both should be strong and stable to uh, make the transaction um, smoothly, right? So global standardization of financial instruments required for that. So every financial instruments requires a global standardization, and this globalization facilitates the movement of funds between servers and borrowers in different countries. That's what I said earlier. Like if I want to, like if somebody is earning they are like having surplus money, so if they want to invest in Sri Lanka, of course, like we have to have um, linkages between finance systems. So globalization support for that as well. Okay, just want to give an example, like a real life example we experienced in 2007, 8, 9 period. So based on that, you can understand what's happening due to the globalization. So now you can see in this chart, um, this is what I'm going to discuss is US subprime crisis, right? You can see in this chart, this is a US home ownership rate. Now, that was around, like you can see from 1955, that is around like 63% to then just moving up to 66%, again coming down, and then it started to pick up from 1996, and then went to like 69% in 2006 period. So now during the period, like the American dream was like everybody should get housing. So then the house price, the ownership went up drastically during that period. So everybody wanted to have houses, right? So if that was the case, so demand was very high during the period. So house prices also picked up drastically, right? You can see in the chart like 2006, 7, 8, like prices went up like maybe double, right? You can see the price index here, and the monthly house price index for US given. So it was like too much during like 2006, 7, 8 period. So it was peak, right? So house ownership went up because of the policy every American should get housing. So then when the demand is high, then definitely like price went up drastically. But the problem is like even though like everybody wanted to have house and they bought and the price went up, but if you see the real salary growth of US people, right, it's like same, a little bit fluctuation you can see, but there's no growth, right? It always up and down and around the zero line. So real salary growth we couldn't see that time. So the price went up, the people bought houses, but they have to pay for installment, but their real salary growth didn't show any improvement, right? What happened now after this 2003, 4, 5 period? People, house owners started to default because they couldn't afford the installment. So they started, normally we call it subprime customers because they are not prime customers. So everybody got the loan from bank and bought the house, and now they were struggling to pay back. So now everybody like failing, the subprime customers were failing during that period. They couldn't pay back the bank loan, and it's went as a crisis, right? You can see the Dow Jones plunged more than 50% from its highs of 14,000 in 2007 to 6,500 in early 2009. You see, it went down to half, right? The best example of this impact is what has been happening with the sovereign debt crisis. You can read some articles which it was very interesting, like sovereign debt crisis in Greece, Portugal, Spain, Ireland, Italy, all had problem debt crisis during that time. Okay, so let's see like what happened to US economy and the magnitude of damage during that time, right? It's exactly like maybe 10 years back we had this issue, right? Okay, this very timely topic might be during this COVID-19 period, you also can think of, right? But now it's better managed anyway, right? So you see the Lehman Brothers stock, 2007 to 11, right? Now it was January 2007, it was like 90, and then January, right, later part of 2008 when nearly zero, right? You can see this. So because of the subprime crisis, Lehman Brothers, right, lost their market, and finally, I think you knew the story. Finally, they filed for bankrupt, right, because of the subprime crisis. And that's a Lehman Brothers investment bank. Okay, let's see what's happened to the manufacturing company, General Motors, right? General Motors, like you can see the 2000. 7 Jan, like it was a peak and it was going down, right? And Jan 9, Jan 10, and Jan 11, it's merely zero, right? Stock prices. And then you can see the City Group, it's a commercial bank. And 2007 starting, it was at a peak and then came down 2009 onwards, right? It's merely 5, right? You can see. And then AIG, it's insurance companies. I have given like several because like one is a bank, other one is a commercial bank, other one is an investment bank, other one is a manufacturing company. This is the insurance company. When something happened to the financial system, you will have not only this financial institution impact, you will have a huge hit on the real economy as well, right? Anyway, that's interdependent, right? So then real economy also will be affected and all the institution will be interdependent. So then they will be affected immediately. All right. So then you can see AIG insurance company, they went down nearly zero, right? And this is a housing bank, Penny May. So they also like after this 2000 data 2008 like 8, okay, that also like and took over by US government, right? So it's a all near collapsed. And Freddie Mae, okay, housing bank, that also had this problem and finally went for like takeoff. Now you can see the stories actually, like you can listen to these YouTube videos and all. It's a very interesting story how that happens, and you can learn a lot of things how that affect um, due to the globalization. And I just want to show this contagion effect, right? When you see contagion effect due to this subprime crisis. Now, in these slides, you can see a bank, Northern Rock, right? It was in UK, right? Due to the subprime crisis that pass it to all other countries, and we have seen the debt crisis also induced by this crisis, and as well as financial system also like badly affected due to this subprime mortgage crisis. So now you understand, like even though it started from US, that has gone to every countries, right? So here you can see Northern Rock share price, okay, and 2008 it's almost share trading suspended. You can see into 31st Jan 2018 and 2008, and after that period suspended, right? So it has been bailed out and then later nationalized, right? Okay, now you can see the pictures like this is the when a bank lose public confidence, right? So everything is based on the confidence. That's what I earlier also said. If you have proper regulations, you can build a public confidence, right? On the stability and soundness of the bank. But when something happened to a bank, they immediately lose the public confidence. So all the people will be piling up with in front of the banks. You can see it's another building. So many people are on queue, right? Now you can see like in photos these northern rocks various branches in various time schedule, right? In the early morning maybe few people, and maybe afternoon it's huge crowd. They wanted to withdraw their money back because they got the news that there's a crisis in this bank. So this is the contagion effect. So even though it starts somewhere else, of course, due to this globalization, you also part of play. You also play in this global financial system. So definitely, you also will be affected. So yes, up to now, I just want to wrap up this one. So up to now, we have seen economic system, and how that works, and financial system, and what are the components of financial system, and each and every components we have seen in a brief detailed way, right? You can you might have seen financial instruments, institutions, markets, and regulations. These are the key things under financial system, and how that depends on other national financial systems. And what will happen is somewhere down the line, if any finance system has a problem, so that will definitely affect others too, because it's always interdependent. So this what today's presentation and discussion. And you can send your comments through message if you clearly understand, or you can send any questions during our discussions or next time, so I can catch up those also during that discussion. So if you have any questions, just let me know. I can give you a 2 minutes time. So if it is no, then thank you so much for listening. Thank you. And one more announcement: next week there won't be any classes, right? So then we will be starting after that week. Okay. Thank you. Take care.